Good afternoon. This is 15th of February. Almost said December. Wow, that would be great. So this is 15th of February and Japan is in recession from today. The United Kingdom is in recession since a year, almost a year. Germany is in recession for a while, and the United States is in recession, but they're just afraid to admit because the administration think that if they admit that they are in recession, they would lose the election this year in November. So instead of that, they just change the term of recession, and therefore they don't admit it. So as you can see, almost technically all of the major economies around the world is reporting a recession since at least 8 months now, and that's just making the situation worse and worse. Sorry, but my little cat is a little bit on the way. So that makes us changing things in the live stream, since you guys getting to understand what this live stream is for and how do we proceed with that. So I made a little change. I will show you, and we will following the market a little bit more professionally, so you can start your work on the right way as it's necessary. So today we're not going to start straight with the 6 main drivers, but rather we're going to start with the market sectors. First of all, with the ETF and the index market. And that might be strange, but you already know what do we watching here. So anything I need to highlight from the 6 main drivers, I'm going to come back when I am explaining to you the market sector, and then you will understand why the point is going up or going down. And of course, as we used to get it, those points are really good to predict a lot of things on the market. But as you know, if you're a pro member, you can visit the website, the English version, and you can just go navigate yourself to the live stream, and you can access this Prezi document, and so you can check that out every single time we are doing any kind of changes. Now here we go, the ETF market is the first, and as you can see, the macroeconomic point slipped lower on the ETF market from -11 to -12 point. And the reason why, because obviously the CPI increased in the United States, which is really damaging at this point to the US economy, and whatever is damaging to the US economy is damaging to all economies around the world. So we need to be careful with that, but we're definitely lowering the point from -11 to -12, while the geopolitical point did not change at all. It stays the same. There is no escalating tensions just yet, but we're hearing things. And nowadays you can read about that, for example, Denmark is warning Europe that Russia can start a war within 5 years. Etc., etc. While there's no proof of it, but obviously the globally we're trying to accelerate the readiness, the military readiness, and therefore probably they see there is no any other way to boost the GDPs rather than the military expansion. So that's what we are focusing on now, and other than that, there is no any major escalation, but we are bad enough in terms of the geopolitics, so therefore the number stays at -9, which is a very negative point. The corporate earnings do not change. The earning reports are, very stable for those companies trying to stay on the top. They're reporting weaknesses. They feeling the consumer activity decline, but at the same time, they still have the power to manage to play around with the numbers and, somehow leave the company alive, while the majority of the stocks and the majority of the companies are reporting very bad earnings. So no surprise, the point is staying on -8 point. The market news and events are declining from 0 to 1 because of the reports we are receiving by the economy. It's not a big decline, but it's slipping back to negative. which is also not a surprise because we can't really spend so much time in positive territory in terms of this point. And so here we go with the market sentiment and psychology, which is a little bit slipping back from 4, is a positive 4 to positive 3 points. Now, to explain that to you a little bit better, if you take a look around how the index, ETF, and the stock market sentiment is developing right now, is that, as you can see, the finance sector is just slipping back a little bit to neutral territory, while the health sector is, it's declining a lot, and it's a very negative territory right now. Same as the tech sector is declining back, a big drop, but it's still in a positive territory, nearly neutral, but it's still positive, but its weakness is very visible on the charts. Obviously, the reaction was very hard and harsh on the CPI numbers, and the retail sales are declining back as well, but it's still on positive territory. While the consumer services declining straight into negative territory, that's not a good news for us right now. And the car sector is also, the auto manufacturing sector is also declining back to neutral territory. Transportation is still positive, but there is a big decline compared to last Thursday. And the energy sector is straight into negative, which is one of the biggest decline in the last 3 days. So pretty much negative, but most of them managed to stay in neutral or positive territory. There's just a few of them slipping into negative territory, and this is the reason why we got the point only to 3 and not any lower. So we are still positive, but there is some changes here, and the technicals are declining back from 3 to 2 points. Now it's also, again, it's still positive, but you know, there is a decline, and to understand why the decline is there, if we take a look on the ETF market, it's just a quick look. As you can see, the S&P 500 bounced back very hard from the top, and that was the CPI number, obviously, which tried to hold the price between the scale EMAs, and we are about to closing this cycle as well. But yes, on Friday I was just confused with the days. So on Thursday, yesterday, we experienced some bounce back from the scale EMAs. So I warned you on the Discord server, but that's I understand that there is a drop. Now the whole market was very excited. We started to get the news that, oh my god, can the market crash right now? Oh my god. And yes, we generally talking about a possible crash of the market for a long term, but that doesn't mean like it's gonna happen from one day to another. You will be at zero. That's a process. It's a long process, as every single time when you have a bear market, it's a long process, and at some point we need to start that. The start is not so easy, but if you understand the psychology of the market and why it does change sometimes, you can understand that it takes time to turn around. So it's not necessarily we not necessarily should think that this is the top right now and there is no more chance to make an all-time high. But obviously, this is a weakness on the chart right now. So that's like, you know, sending a signal for us, especially with the MACD, because there is still no higher high with the MACD, which means that it's possible if we are slipping, if we're making a crossover and an additional 1 or 2 days in negative territory on the MACD, that very easily could be a divergence. It's not the strongest divergence ever I saw in my life, but it's still a divergence. And that now, if that happens, we could get a signal, some of the signal that maybe some serious weakness, slowdown, or even drop could happen on the market. But yeah, we need additional analysis to identify what the possibilities are. The options market is pretty calm. I mean, the VIX was spiking up a little bit, but immediately went down the day after. So there was no real panic on the market. As you can see, the SPY put contracts did not accelerate, but as you can see, the SPX is accelerating. So it's a you know, warning, but not a signal of an immediate danger on the options market. And on the other hand, just remember, I tried to warn you in the last 1 year continuously that technically we have these 0-day options contract anomaly, which could be a really big danger to the market because we don't see them on the wicks, so we just barely can guess what the magnitude of it. but we know the mechanism when they try or start to sell the options or buying the puts. In other words, this could be very devastating because we don't see them, but it's a huge power. There's a lot of money in that. I explained that previously why it's a problem, and also I explained that to you earlier that when they start to sell off, or other words, buying put contracts, it's going to be a huge power, an invisible power. And for example, you're not necessarily going to see on the volume of the S&P 500 until the rest of the market, for example, the Wall Street or hedge funds are starting to react for that. So it's a danger. But as I said, there are warning signals, but there is no signal for an imminent threat yet, at least. And if we take a look around on the balance, as you can see, the RSI is still weakening, still slowing down, while, as I explained that to you, the MACD is very close to signal to us a divergence, but the short-term momentum is still pretty strong, it's still keeping up, so there is no immediate danger, as I said. And this is the reason why I told you that it is very possible that the price is bouncing back from the scale EMAs. Once we see a scale EMAs crossing each other, we're going to see all these signals like the RSI, for example, starting to building down a structure, while we're going to get a confirmed MACD divergence in that case, and probably the stock MTM is start to fall below the 40 line. So these are the signals we are really looking for. Still not sure that it is the best environment for any kind of shorting, but yeah, at least there will be some signal about that. So returning back to the points of the ETF market, as you can see, the overall point is declining back from -79 to, -21 to -25. So that means there is another decline, which trying to predict at least a slowdown in the buying power, but maybe some turnaround on smaller time frames, but I do not expect any major sign on the daily chart, and that's very important. And to understand that a little bit better, as you can see, the main direction on the ETF and the index market, as you can see, the main indexes are technically in bull trend, and they will remain in bull trend even any kind of drop is starting to go. So that's why we need to be very careful with the short positions. At the same time, the general index and ETF market is either consolidating or in bear trend. So yeah, this is diverging, stretching apart, and that's why I needed to change a little bit this explanation. And as you can see, there is a new table here. Well, technically, the direction status is unstable, either to the downside and to the upside, especially with the ETFs. And as you can see, that the sector surprise or support, especially on the main indexes, like this is like the US 30, the S&P 500, the Russell, and larger indexes like that. If you can see that the macroeconomic area is not really supportive right now for the main indexes, because the main index is technically in bull trend, but the macroeconomic environment is trying to push down the prices. So this is an opposition between the two power. While the geopolitics is exactly in the same situation. The geopolitics, the environment does not support any kind of bull trend on the stock market right now. But again, the sentiment and the technicals are pushing up the prices, which remains stronger than the power of the geopolitical effect right now. The reason why is that because traders are really reacting very aggressively. And if you remember, I had a Hungarian weekend video on our Hungarian YouTube channel when I explained that to you, very, very much detailed explanation when I gave you about how the large investors, the small investors, the large traders and the small traders, in other words, the retail traders are reacting right now. And what we see now that large traders and small traders also reacting to the positive side because of this euphoric mood on the market, because the AI, etc., But at the same time, large investors do not react because they are watching the time when they can push the red button. And yes, it might happen already. We're not going to see that because so many people does not understand that you're not going to see when really large investors start to selling. What you will see when the price starts dropping is when traders are starting to sell, or joke investors, as I used to call them. And the reason why is that you can only see the power of investors, I mean serious investors, when the price is declining and it's failing to stop on a support which you expect that the price will stop. So if you see that we go forward and do not stop, even if we're retesting this support after the breakthrough and then continue to go to the downside, this is the signal that investors, I mean the technical signal that investors are selling hard or already sold a lot. So you're not going to see this. You need other analysis to identify the sign of large investors are selling. So this is the reason why you see that the sentiment and the technicals are very supportive on the ETF market. But as I said, on the main indexes, I'm not talking about the smaller indexes, real estate ETFs, etc., really talking about the main indexes. And the same situation is with the earnings. The earnings is very bad, is very negative in terms of a company performance. They are trying to survive. They are in the phase when they are really playing around with the numbers, putting one side to another side, because they need to figure it out how to stay on top of everything. They're even lowering the expectation for revenue in order to report a lower revenue at some point exceeding this expectation. Then the market is stupid enough to react for the news that they actually exceeded the expectation. But yes, the expectation actually way lower than the expectation is supposed to be in order to keep a company healthy. So none of the companies are healthy right now. It's just a question of who can stay on top and who will fall. That's a big question. So this is how we need to understand this market sector. The risky sector is obviously the main indexes, because the majority of indexes and ETFs are reacting, as I said, neutrally or negatively in the bear trend, and therefore they're trying to follow the true power of the economy. Meanwhile, the main indexes are in hype, in euphoria. And they're not reacting on a sensible way, if I can say in that very diplomatic way. So the main risk on the ETF and index marketing, especially for the main indexes, because they are in bull trend only, is a possible economic downturn, which is ongoing. This is a procedure that we are witnessing in the last 1 year at least, and it will continue, especially with the new development with Japan. And so, as you can see, this is a process, and we're going to see the negative impact on the market month by month, while the negative company performance in the magnificent 7, which is already only a magnificent 5, to be honest, because we already lost Tesla and Apple, and we're going to lose Amazon very soon as well. So because they are really responsible for the larger ETFs to going to the upside. If there is any very negative report in the company's earnings, then we will see a sudden disappointment and a turnaround on those ETFs. So this is a main risk. I'm not saying that this is what is going to happen, but obviously there is a very high chance that it's going to happen either on this earnings season or the next one. But that, as I said, that's a huge risk. And of course, the rate cut disappointment could be posing a real great risk to the current main indexes, because until the last CPI numbers reported from the United States, the market thought that, oh my God, the Fed is ready to, lower the rates, while the Fed is just not ready to do that unless there is some tragic situation, of course, on the market. But if not, then the market slowly will start realizing that the Fed is not going to cut rates anytime soon, and therefore they will be very disappointed because they tried to price in the rate cut, which was falsely thinking anyway, but they trying, and therefore if they get disappointed, now that could be a moment when larger investors also pushing the red button, and the Wall Street will realize that and say that, okay, there is enough money for us to suck out from the market, from your pocket, and they're gonna push the red button as well. We're just waiting for the time. It's just a matter of time. It's not like an if, it's a when question. So that's the ETF market right now. And let's see the commodity market changes. The macroeconomic is increasing from 14 points to 15 points in positive. And the reason why, because when the inflation is going higher, that means that obviously this is for certain parts of the commodity market, because obviously not all parts of it, but certain parts of the commodity market is reacting very positively. It represents the inflation itself. So that point is going up with the CPI number increasing. The geopolitics staying at 19 points. It's very positive. Obviously we're not counting the corporate earnings as an effect on the commodity market, but the market news and events can drive some narratives, even if it's on a very low scale of being able to drive the market. Is only 8% responsibility, but still is on positive 6 points, so it's a very positive environment for the commodity markets. However, the market sentiment and psychology is declining from 8 to 6 points. That's a 2 points drop. It could be some kind of profit taking, or just because the energy market is not so strong nowadays, it's rather consolidating, and therefore we see some kind of drop on the sentiment. Not a good sign, but it's not like the end of the world, because if you think about it, those powers like macroeconomics, geopolitics, they are the ones really driving the long-term trends on the market, while the market news and events, the market sentiment and psychology is the ones, or they are the ones that driving the market for the short term, and the technicals are just technically mapping down what is happening, and we can read it from the technical chart. And therefore we see some decline of the technical chart. As you can see, from 2 point to 1 point we're declining back for this meeting, and therefore we see on the overall points that we are declining back from 49 to 47. That's not very alarming, but we failed to make a higher high on this chart, and that could be there could be a sign of a longer consolidation in the overall point, which trying to represent the overall commodity markets. But here is the point, and it's a very, very important point. How should we understand that exactly? Because when we're talking about the overall commodity market, you could be very, very confused. And from that moment, I am making some changes. And as you can see here, also a new table, which I'm going to represent to you how the macroeconomics, the geopolitics, the news, the sentiment, and the technicals are affecting each of the main sectors on the commodity market, which can be divided to 3 different stages or sectors. One is the hedge or safe haven sector, one is the cyclical or growth sector, and the essential sectors. Now, just a little information to you if you wouldn't know that, and you want to learn a little bit more about this market, that safe haven commodities is usually, this term is used in the context of commodities like gold and silver, which investors flock to in times of uncertainty or market volatility, what we're usually experiencing nowadays in the market when there is a sell-offs. So these commodities are perceived as stores of value during geopolitical tensions, for example, what we're witnessing now, economic downturns, what we're also witnessing, and or a financial crisis, which is, the bank sector is just trying to kneeing down, so we are not very far from that. And there is another category which is joining to this group, which is the hedge commodities. Hedge commodities, well, some commodities are used as hedge against certain risks. For instance, the gold is often used as a hedge against inflation and currency devaluation. This term highlights the strategic use of certain commodities in investment portfolios. So we are creating a whole group of that. So you will see when the market is focusing on that, probably there is a market panic somewhere else. For example, maybe in the stock market or somewhere else. Those are the ones really reacting positively on that. But at the same time, we got the cyclical commodities, which are those who demand and the prices are closely tied to the health of the global economy. Examples include industrial metals like copper and energy commodities like oil. And these tend to do well when the economy is expanding, but they are living their own life when the economy is not expanding too much, if you know what I mean. But for example, oil is part of the safe haven, and so if the economy is not very well, the oil could be very positive because of the safe haven asset. And there is another group, which is the growth commodities. It will be included in the middle group. This could be an alternative to, like, let's say, non-defensive commodities, referring to commodities that benefit from economic growth, technological. Sounds like Joe Biden right now. So technological advancement or specific trends, for example, rare earth metals for electronics and renewable energy technologies. You know that we followed that for a lot, especially 2 years ago. And we're going to returning back when we got the opportunities, by the way. So, and there is another group, the last group which is the essential commodities. These are the commodities for which demand remains relatively stable regardless of any kind of economic congestion, such as essential food commodities. This term is commonly used in the commodity market context to reflect the constant demand for those goods. So these are the groups, and therefore we could understand a little bit better how we interpret the information what we got from the macroeconomics, the geopolitics, the market news and events, market sentiment and psychology and technicals. So as you can see, the current macroeconomic environment, which is generally positive for the commodities, is very positive for the hedge and safe haven commodities, and very positive for the essentials, but it's not very positive for the cyclical growth because it suggests a not very healthy macroeconomic environment. Similar with the geopolitics, but this is very positive for all three categories. The news also very positive for all three categories, but the market sentiment, which is not too bad, by the way, but it's declining a little bit, is currently not very positive, with this small declining to the safe haven and hedge commodities. Cyclical growth, all commodities also experiencing some negative effect because of this sentiment decline from 8 point to 6 point. But the essentials could experience some kind of positivity because that in that term, in this situation, those are the safe havens. So technicals are negative for all of them. I mean, the majority. That doesn't mean that every single chart is moving to the downside, but the majority of them, if we take in each group, so for example, essential foods, they are in average declining instead of moving to the upside or consolidating. So, but still, because that's not a big drop on the overall point, it's only really, we are going down from 49 to 47. The main risk on the commodity market right now is the general profit taking, because overall we can see that the economy is still supporting a general bull trend on the commodity market. Also the narratives by the market events and news supporting that bull trend. And the market sentiment is still very positive, but it's somewhat consolidating in the last couple of meetings. So yeah, it's not too bad. It's a little bit slowing market, but it's still very positive. Let's see the Forex market, what is happening in the Forex market right now. The macroeconomic is declining. Obviously, that's because of the increasing CPI, strengthening the DXY, which is the US dollar index. And when the US dollar index is going up, guess what? Everything else, or almost everything else, is going to the downside. So this macroeconomic area is affecting negatively the rest of the forex market, excluded the DXY. Why you see the geopolitics is actually moving to the downside a little bit, and the reason why, because in terms of the geopolitics, we mainly focusing on the financial geopolitical issues, and the fact that Japan is just moving officially into recession will indeed force the Bank of Japan and the Japanese government to issue immediate actions in order to leave the recessionary area as soon as possible, which is not going to be a short-term game. So that means that they're gonna, they're gonna do steps what the Bank of Japan, for example, refused to do so far. You remember how many times we were waiting for the possible rate decision, the possible rate hike decision from the Bank of Japan, which did not happen. But from now on, that's a very high possibility that they don't have any more time to thinking about that. Unless they have some other plans which is very stronger than the possible effect of a rate hike, which I don't know about it. Yeah, that's probably going to happen. So therefore, the geopolitical tension is a little bit, increasing in a negative side. While obviously, because we continuously get the news about that, the news points is declining from -3 to -4 point, and that's not good either for the market. And also we got the market sentiment as reacting for all these negative circumstances, a declining point from -4 to -6. And therefore, because obviously the sentiment is reacting negatively, the technicals will reflect that, and you can see a point decline from -1 to -4. So therefore the overall point, you can imagine, is dropping from -22 to -30, and that's a really accelerating point drop on the forex market. So as you can see, that not much positivity, and this is a serious decline in points. So you will definitely experience that on the charts, but on which charts? And I also made a little bit of an update on that side as well. Here is another card, a new card. So we can say that the main direction on the forex market is bearish, and the direction stated is, yeah. You remember last week I told you that there are possible signs of bearish breakouts on the charts, and here we go. We got those breakouts, so we are already in, which means we are strengthening the momentum to the downside on, I'm not saying all of the currency indexes, but the most of them accelerating to the downside. And therefore, let's just take a look around what sector is supported or could cause a surprise by the 5 major driver which we are investigating in terms of the forex market. Now, the macroeconomic area is very supportive. Why? Because we have a bear trend and we have a very negative macroeconomic environment, so that's supporting the bear trend, and that's very positive for us. I mean, whoever understands what opportunities that means for us on the forex market. Geopolitics is in a very similar situation, because as you can see, we got more negative points on the geopolitical field, which supporting the general bear market. So this is a supportive power on the market. We're not looking the earnings on the forex market, but the market news and events are seriously supporting. As you can see, the negative point is accelerating to the downside, supporting forward the bear trend which we're experiencing on other indexes. And that's the same with the sentiment and the technicals, both of them very supporting, because both of them accelerating the points to the downside, which means we are experiencing a very stable and true market reaction, because the market is reacting for the overall fundamentals and therefore following it. So we can clearly say that this is a very stable trend right now, which we can follow with a with a confident. However, there are risky sectors within the forex market, especially with the indexes. One is the GBP, which indexes the BXY, so this is the British Pound Index, and the other one is the QE, surprise, surprise, so the NZD, which is the ZXY Index, New Zealand Dollar Index on the forex market. Both of them, interestingly, performing a little bit better. Looks like they are a little bit stronger than other currencies. That doesn't mean they don't go to the downside when the DXY accelerating to the upside, but definitely shows less decline than, for example, the Japanese yen, a Canadian dollar, or the euro, for example. So this is something worth to watch. They are not accelerating as much to the downside, at least now. Let's see what's going to happen next week, but we need to keep an eye on that. What that means for a trader, if somebody is looking for a strong currency index which is strengthening to the upside, and a strong currency accelerating to the downside, that's the best pairing method for looking for a currency pair. But when it comes to the GBP or to the QE, we can easily say that they are not very much balanced, because technically they are either neutral or try to strengthening a little bit, and that's not a good idea to pair a positive strengthening, for example, DXY, to a strengthening British pound or a New Zealand dollar. So they are the risky sectors, they are the risky ones. And the main risk for the entire Forex market is the possibility of a DXY weakness. Now, why this possibility is there, and why are we talking about the possible DXY weakness? If I come to here and take a look for the index balances, you can see that the DXY is accelerating to the upside. That's on the left up corner. It's still accelerating to the upside, still above the scale EMAs. It looks stable, isn't it? And this is why you're experiencing the rest of the market is moving to the opposite side. As I said, the British pound, which is in the right up corner, and the QB, the New Zealand dollar, on the left down corner, is not very strong to the downside, but the rest of them is showing huge momentum to the downside. However, and that's a big however, because as you can see, we got the live chart on the Pro server. So if you go there, you can check out in 24/7. And as you can see, we just arrived to a very strong no-go zone on the DXY, which could cause some kind of rejection from the zone. Now, we can start, trying to figure it out, whether we're going to break this zone or not going to break this zone. And we can have a very, very good discussion about that. But in reality, this stays a discussion because we are not God. We're not going to see the future and what the price will do. So the only thing is signaling to us that there is a danger on the chart right now. There's a possible bounce back, a possible rejection, which we are thinking there's a possible rejection, because most of the time when a price is meeting with a zone, that's what happens. So there is a danger, and therefore we need to keep an eye on that. And this is the reason why I name this fact as a main risk on the Forex market. Why is a risk as a category, and why not a good thing when the DXY gets a rejection? Now, the thing is, because what we experienced in the last couple of days is that the DXY is moving to the upside while the rest of the market is going to the downside, which gives us the opportunity to shorting something against the DXY or changing the currency pair tickers and buying the DXY against some weak currency. But that's a good strategy. That's what I'm following every single day when I'm trading on the Forex market. But if this is my goal, that means that, for example, in a now, this is just an example, okay? So if I go bullish on the USD Japanese yen chart, a possible rejection from a zone on the DXY chart is a risk for me, because I'm in a buy position and I could get a correction because of this rejection. And so that's a risk, that's a danger. Now, because, this method of choosing a currency pair, what I just told you, that I'm pairing the strongest with the weakest, and therefore I got the direction and everything, you can do that on a different way. You can try to trade in a different way, but then you're trying to pee against the wind, as we used to say in Hungary. So yeah, that's what usually, it doesn't really worth to do that. And therefore, it's wise to think that this is a main risk. So this is the Forex market right now, and the stock market is not much different from the ETF and the index market, but it is different. You experience the same with the macroeconomic effect on the market, which is declining from -10 to -11 for the very reason I just mentioned. And the geopolitical point is staying at -9. Why the corporate earnings is staying at -13? I explained that to you, what the reason for that. Market news and events is also declining from -1 to -2 points, and the market sentiment and psychology is also declining from 1 point to -2, so we're returning back to negative territory, which is not a good news, by the way. Strangely, the technical points only declining from 1 to 0. Don't forget that, please, that we are not only investigating with this method the large company share prices, which including in the larger indexes as well. Excuse me. But we're also investigating I'm not saying the whole stock market, but each of the market sectors is very important for us, and we have assets we are following, and so we can have an assumption how the market is doing right now on each, even if you break it down for each market sectors. And I explained that to you a couple of times, that just because we have a handful tech companies that they are really strong, I mean, the rest of the market is in line with the economy. If you get those tech companies out of the S&P 500 and then trying to represent the price line of the S&P 500 without those companies, you can see the clear moving of the market, and that is not positive. So the technical setup on the market is not that positive. I could say that if I break it down and take a look on the NVIDIA chart, of course, that would be extremely, we would get the maximum 20 points here. But the rest of the market, unfortunately, is not. And so therefore, this gets a 0 point just because we know exactly that how strong those companies' capital are, and they're outbalancing the rest of the market. But it's still a balanced market, as we can see. And therefore, the overall point is declining back from -31 to -37. And that's a pretty big decline. Still, there is no low just yet, but there is either no higher high. So that's a clear consolidation. And until we're not moving any lower than -38 point, we are remaining in the consolidation. If we are remaining in the consolidation, there is a very possible point increase next time when we got a meeting, unless there is some panic is evolving on the market. So if to break down a little bit and understand a little bit more, let me explain that to you. Here is a new table again, a new card, if you will. And so I will make two different groups on the stock market so you can understand which part of the market is likely reacting positively because of the environment we are investigating here, and which part of the market is likely will decline. So there is two major category within the stock market. One is the defense, and the second is the cyclicals. Let me just tell you a couple of things about the defense, so non-cyclical stocks. So defense stocks are those that tend to remain stable during a various economic condition, including the downturns as well. So these stocks represent the companies whose products and services are always in demand, regardless of the state of the economy. This category includes like utilities, so essential services like water, gas, and electricity. Consumer staples like products like food, beverages, and household goods, so that consumers need regardless of any kind of bad economic condition. Healthcare, for example, is included in this group, services and products that people require for health reasons, which do not significantly decline in demand during any kind of recession, which is here. Recession is here, guys. And also, defensive stocks are considered safer investments during any kind of economic downturns or periods of market volatility, as they offer steady dividends and stable earnings. Ta-ta-ta-ta! Here we go. And there is another group, which is the cyclical stocks. Now, cyclical stocks, on the other hand, are significantly affected by macroeconomic changes. So their performance is closely tied to the health of the economy. During periods of economic growth, these stocks tend to perform well, but they can be hit hard during a recession. And this category includes like consumer discretionary, so companies providing non-essential goods and services such as luxury items, entertainment, and, for example, automobiles like Tesla. Industrials, like firms involved in construction, manufacturing, and, for example, machinery, which are sensitive to economic cycles. Technology, for example, is in the cyclical stocks. While some tech companies have some essentials, obviously, and that's absolutely true, the sector overall can be cyclical, with spending on tech goods and services fluctuating with economic conditions. And remember when I explained to you that there is a difference between tech company and tech company. There is a tech company which is doing a business to consumer service. And there is another tech company, for example, Microsoft, which is doing a business-to-business services. So if there is a recession, business-to-consumer companies are likely going bankrupt, likely having a decline, a bad performance period. But companies who's making services from business to business, those are the ones likely survive at such an area. But here we go, financials. So like banks, investment companies, and insurance companies, which are directly impacted by interest rates, for example, the high interest rates globally right now, and economic health as well. Technically, the cyclical category thrives when the economy is doing well, and increased consumer confidence and spending boost revenues and profits. These two categories help us to actually to understand potential risk and opportunities by assessing how different stocks might react to the economic cycles we are discussing every single week. Defensive stocks offer stability and are often sought after the potential to provide consistent returns in both good and bad times, while cyclical stocks offer higher growth potential during economic expansions, but carry greater risk during a downturn, which we are experiencing right now. Now, so with this explanation, you can clearly understand why I am investigating the macroeconomics, the geopolitics, the corporate earnings, the market events and news, and the market sentiments and technicals. Because when we take a look around, the macro is very positive for the defensives, but very negative for the cyclicals. And there are exclusions, There are, for example, Nvidia, who is making business to business. For a while, they can do well, but technically the macroeconomic environment is very negative for them as well. And you can see on the earnings that they have some struggles, very serious struggles, actually. The geopolitical environment is right now very negative for the very positive for the defensives and very negative to the cyclicals. Same as the earnings, same as the news, same as the sentiment. And the technicals is the only one that is neutral to negative for both of them. At that moment, at least. So, as you can see, now you can identify the sector which sector of the stock market is performing better and following the economy, and which is the sector which is detached from reality and does not follow the economy. Now, the stock market is usually not following the economy on a short term, but following the economy on the long term. So if you see something is exploding to the upside while the whole world is almost burning, that's an unusual thing, and not called a bubble. It's not going to be a bubble because of this. There is so much other factors why it's going to be a bubble, but that's just the signal of it. And the risky sector from both is obviously the cyclicals, because there is more and more risk, as you can see. Main risk for the defensive sector is a general profit taking. which could take months, even months, making a month-long correction or just a couple of days or hours. But it's a risk. While the risk on the cyclicals is either profit-taking, rate cut disappointment, which we talked about it. Bank sector crash could be a huge risk because can affect other market sectors as well. Real estate crash, obviously, first, it will be very negative for the bank sector, but then it will spiral out to other sectors as well. Tech bubble pop. So if Nvidia fails, then the whole stock market will fail. That's just, you better to know that. Tech bubble pop is that huge risk. And the zero-day options trading, which I explained that to you 100 million times, where it's a great risk on the stock market. So this is the current situation on the stock market right now with a declining overall point. We need to be very careful, but we're going to check out a couple of stocks. And by the way, you can offer me a couple of ticker and stocks on the Discord server if you want to hear any of the companies, and we can just talk about on the live stream, technical analysis side of the live stream if you want to. Now there's a low amount of people asking about that, but which I'm surprised, but I'm waiting for that thing is going to accelerate, because otherwise I can't help you. Yeah, that's all. So, but here is the crypto market, and the crypto market is well, it's a big surprise, but it's a very good surprise. First of all, the macroeconomic environment is worsening. So that was minus 13 points for a while, for over 4 meetings, and now it's declining to minus 14. Now, if you're asking me why this is happening, I explained that to you earlier, that when it comes to macroeconomics relation to crypto, we got to talk about the financial relations to crypto, and we talk about the possible like financial market cap, if you will. Then an increasing CPI number is very bad for the crypto market, because that will or could reduce even further the money supply. If the money supply is very low, the retail sector, the retail trader sector of the crypto market is likely not to pay much more money into the crypto market. The money can come from other places as well, but that's a threat. And as long as we're not going to start printing money in the United States, in the United Kingdom, in the European Union, etc., we're not going to experience any money supply extension. So that's a bad thing. And even if we start with a rate cut to changing monetary policy and start, printing money, that's not like the money can go from 1 minute to another to people and start, accelerating the stock market. It takes time. It takes a long time, but I had a lot of education how it works. So if you're wondering how it works, go to our podcast, and I was detailing to you so many times that how it works when they start to printing money, how many times we need to, general people accessing this money over the banks. So that's the reason why the point of macroeconomic effect on the stock, the crypto market is declining from minus 13 to minus 14. Now, obviously, this is a negative effect, but, a crypto market, if the crypto market is having fun, then the crypto market doesn't really give a damn about any kind of macroeconomic effect until a point. And we're not going to get to this point anytime soon, it looks like, at least. Because the geopolitical effect is not, it's not weakening at all. It's staying at positive 4 points. While, corporate earnings, there is no effect on that. But the market news and events is accelerating from 7 to 8 point finally, because that's a very long decline. And I'm not happy to see that. But increasing from 7 to 8 points is very positive, and it obviously could give some kind of boost to the market. Now, what is this? What is this positive news? Now, the positive news, at least the new one, because we had previously other positive news for the crypto market, is the ETF capital inflow increase, what we experienced in the last couple of weeks. And the crypto market is very happy about that, and they're hyping very much. So that's why the point increase. and the market sentimental psychology is extremely positive. It has an extreme growth from positive 3 points to positive 10 points. That's a 7-point increase at once. Very huge, providing very strong momentum. Or at least we should see on the technical points, because if we got the volume as well, we see the strong momentum as well. Now, the technical points is increasing from 0 to 5.